Okay, let's dive right into this. Welcome to today's explainer. We're going to unpack something that gets a ton of hype but is honestly deeply misunderstood in the digital asset space, the Bitcoin halving. Now, if you track the markets, you've probably heard folks talk about the halving like it's this magical switch that automatically sends prices straight to the moon, right? Just because the supply of new coins gets cut. But honestly, that's kind of an illusion. Or, at best, it's just half the story. So today, we're popping the hood. We're going to look at the halving not just as a basic scarcity event, but as a massive, brutal, and frankly fascinating industrial shock that forces an entire sector to either adapt or die. Let's look at the contrast here. For the public and most retail investors out there, the halving is framed as a price scarcity event. It's this exciting narrative about supply and demand. But for the miners, the actual companies running the hardware that secures the network, it's a massive industrial cash flow shock. We are talking about an overnight, unforgiving squeeze on their entire business model. Imagine waking up one morning and your absolute primary source of revenue has literally been slashed right down the middle by a line of code. So here's how we're going to systematically break this down today. First, we'll look at the halving revenue shock. Second, hash price and miner economics. Third, the disappearing cost advantage. Fourth, consolidation and the AI pivot. And finally, we'll wrap up with future mining industry risks. All right, part one, the halving revenue shock. Imagine a factory where the price of your goods is suddenly slashed by 50% overnight, but your operating costs stay completely fixed. Let's actually look at the math here, because it's pretty wild. Back when the network launched in 2009, miners were getting a whopping 50 Bitcoin per block. Then, roughly every 4 years, or every 210,000 blocks to be exact, that number gets sliced in half. You can see the progression right here. It goes from 25 down to 12.5 to 6.25, and after the 2024 halving, we're sitting at just 3.125 Bitcoin per block. And remember, this isn't some temporary market dip that you can just wait out. It's a permanent protocol-defined drop in revenue. Revenue falls overnight, but your costs, they remain exactly the same. Think about it. Your electricity provider, your payroll, the bank holding your debt, the guys who sold you the ASIC machines, they absolutely do not care that a Bitcoin halving just happened. They expect to be paid in full. And hey, the halving just hit is not going to fly as an excuse for a late bill. It creates this immediate industry-wide margin test. Because unless the Bitcoin price instantly doubles or transaction fees absolutely skyrocket to fill that gap, miners are getting squeezed on day one.
Which brings us to section 2, hash price and miner economics. To survive that margin test, we really need to look at the underlying math.
Now, what's really interesting about this slide is this specific metric right here, hash price. If you take away just one technical term from this entire explainer, definitely make it hash price. This is basically the ultimate pulse of a miner's financial health. It measures the revenue generated per unit of hash rate, which is usually quoted in dollars per petahash per day. It takes the Bitcoin price, the block subsidy, transaction fees, and network difficulty, and smashes them all into one single vital number. When a halving hits, hash price falls off a cliff, unless the market bails the miners out right away with a massive price bump. Here's the simplified formula that essentially dictates a miner's life. A miner's revenue is just the total network rewards, so subsidy plus fees, times their own hash rate, divided by the total global network hash rate. Basically, your slice of the pie depends entirely on how fast you are compared to everyone else on the planet. I think people sometimes think mining is just turning on a machine and printing coins. It's not. It is a fierce, hyper-competitive global race. And here is where the invisible squeeze really kicks in. You might be thinking, well, if Bitcoin's price goes up in a bull market, all the miners just get rich, right? Actually, no. When the price rises, mining becomes way more profitable, which attracts more capital and more machines. But to keep block time stable at around 10 minutes, the Bitcoin protocol automatically cranks up the network difficulty. So even in the middle of a raging bull market, you are suddenly fighting harder and harder just to mine the exact same fraction of a coin. If your facility isn't expanding faster than the rest of the network, your revenue is literally getting diluted. Let's move on to section 3, the disappearing cost advantage. The era of easy mining is well and truly over. Back in the early days, like around the 2012 or even 2016 halvings, you could basically win just by finding some cheap electricity and plugging in whatever hardware you could find. But that era, totally gone. Take a look at this new competitive stack. To survive as a top-tier institutional miner today, you need subscale-resistant power contracts. You need fleets of the absolute most high-efficiency ASICs, a rock-solid treasury to survive the volatility, grid services, data center optionality, the whole shebang. It's an incredibly complex blend of capital access and flawless operational execution. So, the crucial point is this: your pure electricity rate isn't the only thing that matters anymore. It comes down to your all-in cost per usable hash and your all-in cost per Bitcoin mined. You could have dirt cheap power, but if you're running ancient, inefficient machines, you are absolutely going to lose out to a competitor who pays a little more for their electricity but is running vastly superior, ultra-efficient rigs. Section 4, Consolidation and the AI Pivot. Let's talk about the strategic endgame for this industry. 3.125. That number is literally driving everything in the mining space right now. With the block rewards sitting at this starkly low figure after the 2024 halving, the margin pressure on these businesses has honestly never been more intense. And when margins compress this tightly, undercapitalized or inefficient miners get shoved right into a corner. They really only have three brutal choices. Number one, you upgrade your machines, assuming you can even raise the capital to do it. Number two, you merge with a bigger player or just sell off your assets. Or number three, and notice that bright pink shut-off warning here, you are forced to shut down completely. It is a vicious, unforgiving cycle of margin compression that routinely cleans house, forcing the network's hash rate into the hands of the most efficient, deeply funded operators. But for the massive, top-tier miners who do survive, there's this incredible new pivot happening right now, shifting toward AI and high-performance computing, or HPC. Think about it. If you're a miner sitting on prime real estate with massive locked-in power contracts, you can monetize that infrastructure without just mining Bitcoin. But, and it's a big but, AI workloads need incredibly high reliability power, intense fiber optic connectivity, massive cooling designs, and huge capital expenditure. So while it's an amazing lifeline for the top-tier guys, a dusty mining shed out in the middle of the desert isn't going to magically become a cutting-edge AI data center overnight. Let's move to Section 5 and see how this all builds up to future mining industry risks. Because even the best, most well-capitalized operations out there still face severe systemic headwinds. If the price of Bitcoin drops, that's an immediate, painful hit to their dollar revenues. Then there's the difficulty arms race we talked about. Miners can literally lose profitability even when Bitcoin's price is going up. Throw in ASIC supply chain disruptions that could totally freeze their ability to upgrade. But honestly, the most fascinating risk is the uncertainty around transaction fees. As the block subsidy inches closer and closer to zero over the coming decades, miners are going to have to rely heavily on user transaction fees to survive. And right now, those fees are wildly unpredictable. I actually want to read this quote to you directly because it absolutely nails the paradigm shift we've been talking about today. The Bitcoin halving cycle is not just a scarcity story. It is an industrial margin compression cycle that forces mining to professionalize, consolidate, and increasingly compete with the broader market for energy and compute infrastructure. Seriously? Wrap your head around that. This isn't just some niche crypto cycle anymore. It's a full-blown energy and compute infrastructure cycle. Which leaves us with one final, incredibly provocative question to ponder. As margins continue to compress, and if the absolute most efficient, resource-rich Bitcoin miners decide it's just more profitable to pivot their infrastructure to power the AI boom, who is going to secure the Bitcoin network tomorrow? It's something to think about. Thank you so much for joining me for this explainer. Keep questioning, keep learning, and I'll catch you in the next one.